Hello and welcome subscribers to the Saturday Summary for August 30th of 2014, your weekly summary of market and economic news for annuity and life insurance professionals. As always, I'm Jonathan Illig of Brokers Alliance, here for the biz. Glad to be back after last week's hiatus. Well, August ends with the S&P 500 at a record closing value of 2003 on very low trading volume. Talk about that in a moment. August was good in the markets despite increasing geopolitical risk and the problems being forecast by decreasing bond yields. Now, the S&P 500 index gained 3.7% in August, with the NASDAQ and the Russell 2000 indices climbing by nearly 5%. Now, the S&P 500 has now outgained gold for the first time in 2014. Now, the markets rose this week largely on the strength of the US dollar as compared to the euro, which is floundering as the EU continues to struggle to keep its head above a recession. And the week also featured moderately good economic news for the most part, but not good enough to drive the markets down. Now, the strength of the August rally in the equity market is suspect by many, however, as the trading volume has been extremely low. Now, most market watchers agree that when the markets rise with a high volume of trading, that's an indication that the increased price value of those stocks is genuine because a lot of traders believe so. With low volume, as we've been seeing throughout the month, meaning, of course, not a lot of activity or shares being traded, the strength of the price increase is suspect because the price of a given stock rises only because a much fewer number of traders want to buy it at that price. Well, the pundits of the financial press this week were largely focused upon three issues. The first, as has been the case for months, is the continued rise of the equity markets in the face of headwinds that, absent the ongoing central bank interventions, in a normal environment would have reversed or flattened some time ago. Now, the second major issue this week was the reduction in corporate stock buybacks that have been one of the primary drivers of the bull market for the past couple of years. And the third is the debate about whether the equity markets or the bond markets are correct in the signals they're flashing as regards the near and midterm future of the equity markets. Well, we can dispense with the first issue, that is the continued seemingly irrational rise of the equity markets, as we've been discussing that in the summary for some time. Now, let's talk about the reduction in corporate stock buybacks. Share repurchases by corporations are as high as ever in history, actually at a record level. Now, as discussed in this summary previously, this has been a major contributor to the overall increase in the U.S. stock markets. Now, this chart here compares the stock price increase of companies who have been buying their own stock to the stock price increase of those companies that have not been doing so. I think the chart speaks for itself. Now, as detailed at the article on page 7 of the written summary, analysis is that the pace of these buybacks is now decelerating rapidly. The analyst in that article states, and I quote, "The elephant in the equity buying ring has been the U.S. corporates themselves, who have been hoovering up stock at a prolific pace financed with debt." End quote. With the now evident reduction of companies buying their own stock, if for no other reason than looming problems in the bond markets, we'll talk about that in a minute, but this bond market that issues the debt used to fund these stock purchases, the author continual comments, and I quote, "The end of the buyback bonanza may well prove to be decisive for this bubble." Indeed. Is that a hissing sound I hear? End quote. The point here is that as the Fed's QE stimulus program winds down and finally ends in October, the excess free money machine that has provided the fuel for the stock markets is also winding down, with an expected negative impact to the stock markets. In fact, the author of that same article states, and I quote, "Companies themselves have been the only substantive buyers of equity. But the most recent data suggests that this party is over, and as profits also stall out, the equity market is now running on fumes." End quote. Thus the origin of the summary's headline for this week. Well, speaking of the Fed and QE stimulus, the permanent open market operations, this is how they inject the stimulus through bond purchases, in September will be only $15 billion and only take place over 11 different days. This is significant. And you can see the dates and purchase amounts here and at the article on page 14 of the written summary if you have interest in that. Well, next issue this week was who's right, the stock markets or the bond markets? Now, this debate's getting a lot of attention. In a nutshell, rapidly falling yields on bonds of all types has historically been a signal of a coming price drop in stocks. This is because, as we see at the chart here, that historically there is a correlation between rising stock prices and the subsequent rise in bond yields and vice versa. Well, note at this chart that as the markets rise, so do bond yields, and again, vice versa. Now look at mid-2011, about 3/4 of the way to the right on this chart. We see a sudden and sustained break in this correlation, with the market rising and bond yields dropping. Well, financial pros are warning that this portends a drop in the stock markets. To quote Lance Roberts of STA Wealth Management, quote, "Both stocks and bonds cannot be right," end quote. Well, CNBC's ubiquitous Jim Cramer chimed in on this debate early this week with the comment, and I quote, "But I am willing to bet that it's the stocks that are wrong, not the bonds. But you can dance until the music stops," which is the second week of October, many moons from now, end quote. Well, again, those predictions, maybe October, maybe not. Rarely are people right when we try to predict these things. Anyway, this brings us to the related issue of what is being called the bond bubble. Well, as detailed in the article on page 5 of the written summary, it's titled "Beware the Enormous Bubble in Bonds." The market value of bonds has skyrocketed as yields have continually dropped over the past year. To see this, you need really look no further than the benchmark U.S. 10-year Treasury note, which has declined almost 15% over the past 12 months and over 22% since the start of 2014. Well, to quote the article at page 5, quote, "Global bond markets total over $100 trillion in size, and the derivative plays that are layered on top are several multiples of that. There's just a tremendous amount more capital at play with bonds relative to stocks." Now, in a normal, non-bubble environment, we'd expect that more supply coupled with lower credit worthiness would lead to higher yields. But in the midst of a bubble, we often see the reverse, and today we are, end quote. The author continues with, quote, "Rising issuance, following credit quality, fewer creditor protections, diminishing yields, insider selling, and evaporating liquidity, and our dashboard is blinking with warnings of risk, risk, and more risk," end quote. He concludes with, quote, "And so here we are, facing another bubble, one larger than any we've ever lived through. And as with every bubble, the only remaining question of any value is, who's going to eat the losses?" End quote. Well, this is just one of the values of using guaranteed annuities as part of an overall retirement portfolio. It's the transfer of that bond market risk and income risk from the individual to the insurance company. Remember, annuities are risk transfer vehicles, and not only for equity market risk transfer, but also for bond market risk transfer. Finally, we'll end with our quote of the week, this week from Steen Jacobson. He's the chief economist and chief investment officer for Saxo Bank, who on Wednesday said, quote, "Yes, it's time to be defensive, very defensive," end quote. I need not add anything to Mr. Jacobson's comments. Well, that's your Saturday summary for Saturday, August 30th of 2014. Listen, have a great Labor Day weekend. We'll see you next Saturday.